inflation in Europe is exactly where they want it to be, all the while the economy in Europe is also stagnant as can be. So the next move for Europe is eyes are on the European Central Bank as inflation in Europe has dipped below 2%. Now, with economic pressures easing, Europe is set up for an interest rate cut in October. Now, in this video, we're going to discuss current economic conditions in Europe. We're going to talk about a potential interest rate cut and what that might mean for their economy, what it might mean for the rest of the world. Now, before we get started, two things that I have to ask for. Smash that thumbs up button for me. Give your thumb a workout. Your thumb deserves it. And also, if you would like, leave a comment down below with your opinion on the topic. Europe has a target inflation of 2%. Now, this is similar to the United States, to Britain, and honestly, a lot of places in the world, Canada and other places. 2% is the magic number. Now, 2% is the target inflation because central banks have two jobs. It is good employment numbers and price stability. Now, 2% comes in as this magic number because it allows the Fed in order to achieve their dual goals. Now, falling under 2%, that also does cause some economic challenges, just like operating well above it causes challenges as well. Now, inflation is never going to sit right at 2%, and in various different categories, it's going to go up and down depending on other factors that are going on in the world. But 2% is that magic number. Europe is looking to achieve it, and they have just recently fallen just under it. Now, Eurozone inflation fell to 1.8% in September. Core inflation, which takes out energy, food, and more volatile categories, came in at 2.7. And understand the European Central Bank is made up of a lot of different members that have different type of economies, so the inflation isn't the same in every single place. But in key areas across Europe, including France and Germany, inflation has fallen under 2%, around 1.8% inflation for the month of September. Now, September's inflation data comes in with a warning as well that there might be some turbulence in the coming months, meaning that inflation might go up a little bit in the coming months, but inflation in Europe is exactly where they want it to be, all the while the economy in Europe is also stagnant as can be. So the next move for Europe is to drop interest rates in order to stimulate the economy. Now, the European Central Bank has their next meeting October 7th, and there has been some debate recently if they will drop interest rates at that time. They've dropped rates recently. Other meetings, they haven't dropped rates, and you're very tight-lipped about it. They said that they will consider this information at their next meeting, which is fair enough. Take this inflation information in mind, but also whatever other reports and data and the members that meet, let them discuss if an interest rate cut, is the appropriate thing. Obviously, there's more involved to cutting rates than just the inflation data, especially for a central bank that operates like the European one, just because it's different than a place like the United States. The United States Central Bank, you operate for one group of people, one country. In Europe, with the system that they run, it's just a little bit more challenging. And in the Eurozone in general, the economy is very stagnant. They're not getting any growth around it. Obviously, we've had that report recently that they need to pump in money into the system in Europe. They need to invest in technology and into the continent in order to not fall behind the United States and China. Well, the central bank came out and said that it's not their job to pump in the money. Sure, they believe that something needs to be done in order to get growth going, but they're not the ones that provide the money. The actual countries have to come up with a way to do it. Well, some countries might be able to pump in money and to do that, while others might not be in a situation where they think that it's necessary or might have the means to. So just different challenges that go on in Europe compared to other places things that the central bank can control, things that they can't control. Now, some economists, before they thought that a rate cut in October might not take place, I'm seeing more and more analysts and economists that are saying that an October rate cut would be appropriate at this time because, again, operating under 2% inflation is also not necessarily a good thing. You don't want inflation to get down to 0% or for it to be negative. Deflation, those cause different economic challenges that you do not want to have, just like you don't want to have an inflation that's too high and being a strain on the people. You do not want the opposite issue as well. They are both issues. That 2% target, they're right around it, and I do think something like a 0.25 rate cut would be appropriate for Europe, just to kind of ease things for businesses, ease things for consumers, get interest down just a little bit. It's not going to make a huge difference, but it is going to give some relief to an economy that's stagnant, to an economy that could really use it. Now, if you like content like this, smash that thumbs up button for me. Give that thumb a workout. Your thumb deserves it. And also, if you would like, leave a comment down below with your opinion on the topic.